Now, this is one of the fundamental topics in financial management. Last semester, the examiner brought 11-mark question on business valuation. And every semester, it's there. It's constant. So remember the constant topics I told you. Cost of capital is going to be there. You're going to do it in the exam board. Calculation of WACC is going to be there. So if the examiner puts you at WACC, you know that he's actually asking you to do KD, KE with dividend valuation model, or KE with what? CAM. Then another constant topic is the issue about business valuation. That is constant as well. Now, not the calculation aspect only about business finance, because the topic actually is business, about cost of capital, but the topic actually is business finance, which I said is split into two: sources of finance and what? Cost of capital. So where do we get the money from? Is the source of finance. How much do we have to pay to the providers of finance? Is what? The cost of capital. So another major area that the examiner is going to be setting question on is business valuation. But why business valuation? Why do we have to value a business? So let's look at some reasons on valuing a business. In your opinion, what do you think are some of the reasons why we need to value a business? If there is going to be any takeover. So in acquisitions arrangements, yes, we need to value what? The business. What else? If there is going to be a merger, so let's put that together. Acquisition and mergers, we need to what? Value the business. So Tigo and Tigo and then Airtel. Before they merged, the two companies were valued. So they knew the value of Tigo, they knew the value of Airtel. So when they merged, we now know what? The combined value of the company. So either there is going to be a takeover, or there is going to be what? The merger arrangement. They have to value, or we have to value the two companies. What else can we talk about? What else can we talk about? Listing requirements. When a company is going to be listed on the Ghana Stock Exchange, there has to be what? Value. So before MTN got listed on the stock exchange market, MTN was what? Value. MTN was value. So they didn't just get up to say MTN share to be what? 0.75. They valued it. So if you read the prospectus, I don't know if you read the prospectus, because you were not interested in buying the shares, so you won't even read for academic purpose.
I'm very concerned with shares. I don't really invest.
Okay.
In shares, so anything concerning shares.
You don't like. No, but for the academic purpose, get it and read it, because in that thing they use various methods to value MTN. And some of those methods are what we'll be discussing today, and some in advanced what? Financial management, which unfortunately you will not do because it's out of the syllabus. But they are there. So when a company wants to be listed on the stock exchange market, we need to what? Value that company. Then the third thing is, if it is about raising finance. Raising finance. Now, you can raise finance by being listed on the stock exchange. But MTN didn't go to the stock exchange market because they wanted money. All the shares they sold, they used it to pay for the listing requirements and to the existing shareholders their shares. That's all. So MTN got listed because it was part of the requirements of the contract they signed with the country, with Ghana, that when they become a 4G company, 25% share of the company would have to be, or they have to be listed on the Ghana Stock Exchange market. So they were just, I think 25%. So at least. Yeah.
The rest can be. This one is not fair.
Why is it not fair?
25% be listed on it.
Yeah, at least. I don't know. I've forgotten the actual figure, but I think it should be something like that, 25 or 30%. But certainly. So it wasn't the whole shares that were being sold, just a portion of MTN was being listed. So MTN didn't go because they wanted what? Money. They went because they were fulfilling legal regulatory requirements, period. Are you getting it? But then we can be listed on the stock exchange market with a concern of what? Raising finance. Or sometimes if you are looking for finance and a venture capital company is coming to invest in the company, because they are going to be taking equity ownership of the company, they want to look at what? The value of the company. So if you want to raise finance from venture capitalists or on the stock exchange market, then we would have to what? Value the company. So these are some of the reasons why businesses are valued. We're talking about business valuation, we just started, and these are the reasons of valuing a business. We said we can value a business when there is an acquisition or a merger arrangement, or when you are being listed on the Ghana Stock Exchange market, or when you want to what? Raise finance. Now, usually, the common way that businesses are valued is when there is acquisition and what? Mergers. Now, when there are these acquisition or mergers, there are some risks that are associated with acquisition. So let's look at the risks in acquisition. Two major risks in acquisition. The first one is called business risk, and the second one is called financial risk. Two risks associated with acquisition. The first one is called business risk. The second one is called financial risk. What is business risk? Business risk is the risk that is associated with the day-to-day operations of the company or of the entity. That is business risk. Okay? The risk that is associated with the day-to-day operations of a company. Business risk can also stem from the nature of the business. Nature of the business. Now, when you take a financial institution, what is the business risk for a financial institution? Any ideas? What business risk do you think is associated with a financial institution? Non-performance loans. So the risk that we give loan to people and they won't pay. That is risk. How about insurance? The possibility of paying more than how much a person has what? Contributed, or paying more indemnity during a short what? Period of time is because of what? The nature of the business. So the nature, the operations of the business, the risks associated with that business is what refers to as the business risk. Second one is about financial risk. This is the change in the financial gearing of a company. This is the change in the financial gearing of a company after acquisition. It is the change in the financial gearing of a company after acquisition. A change in the financial gearing of a company after acquisition. For instance, if A is acquiring B, and A, the source of finance they are using to acquire B is that they went to borrow money. And the money they borrowed to acquire B, they put the money on the face of the balance sheet of what? B. In this case, B becomes the target company and A becomes the acquiring what? Company. Now, or the predator company. Once they borrow the money, put it on the face of the balance sheet of the target company, it means after acquisition, the gearing ratio of the target company will go up, thereby deterring other entities to come and also what? Buy that company. So that is what we mean by financial risk. The change in the financial gearing of a company after acquisition. Now, why are these risks important? Because it is these risks that direct us to the types of acquisition that we have. So the change in the business risks or financial risks after acquisition leads us to what we call types of acquisitions. There are three types of acquisitions that we have to talk about depending on the change in the business risks and the finance risks of the company. So we have what we call type 1 acquisition, type 2 acquisition, and then certainly type 3 acquisition. With type 1 acquisition, there is exposure to business, there is no exposure to business risks or financial risks. There is no exposure to both financial risks and business risks. What does that mean? It means both the predator firm and the target firm are in the same industry. Understand this carefully. So with a type 1 acquisition, the predator firm is not exposed to any issue about business risks or finance risks. It means the predator firm and then the target firm, they are all in the same industry. What does that mean? Like a financial institution acquiring another financial institution. In that case, they are all in the same industry. They all have the same business risks. So in that set of acquisition, there will not be any change in the business risks. Type 2 acquisition. Type 2 acquisition. With this acquisition, the acquirer is exposed to business risks. It's not exposed to business risks, but it's exposed to finance risks. So the acquirer or the predator firm is exposed, it's not, sorry, hey, why am I mixing this? It's not exposed to business risks, but is exposed to what? Finance risks. That is type 2 acquisition. Now, why could there be an issue like this? When a company acquires another company and they are not exposed to a business risk, but they are exposed to what? Finance risk. Why? It could be because the predator company is acquiring a target company with a high liquidity or debt facility. Okay? With a high debt facility. So if you are acquiring somebody who owes a lot, then it means you will be exposed to what? Finance risks. There will be gearing on the face of the balance sheet of the company. Then the third one, type 3 acquisition. Type 3 acquisition. This is a full diversification. So it is where it is where the predator company or the acquirer is exposed to both business risks and finance risks. And it happens under the scenario of diversification. Like an airline company acquiring a social media company, or an education institute acquiring a financial institute. It is called what? Diversification. When they diversify, they are exposed to what? Business risk. Because airline company is familiar with airline. Now they have gone to acquire a social media firm. A social media company has a different what? Business risk. So they are going to be exposed to that risk. And certainly has a different financing structure. So they are going to be exposed to what? Financing risks. So these are the three types of acquisition. And the reason why we categorize these is because of the types of risks that the acquiring firm is exposed to after acquisition. Now, let's look at methods of valuation. Please, everything we are about to do here, most of them, almost everything you know already. So it's a revision class. Monsieur,
I said revision.
Monsieur, what the biscuit is show when you sell to me? Monsieur, revision class. What is a revision? What did you say revision? I don't teach you because they've blast away the ball. Now, it's a revision because I told you that when we were doing cost of capital, I told you when we get to business valuation, we will just flip things up. It's my more freestyle of why I said it's revision, freestyle. I told you that KD is I over what? What is PO? Market value. So now if you are valuing debt, it becomes PO equals I over KD. Any revision?
It's a new thing.
Maybe we will do one. You are used to
the interest in the market value.
What we know is KD is equal to I over PO.
I don't blame you people. So it's a revision. So we are just flipping this up. Then I also told you that KE equals DO over PO. Do you remember this formula? Do you remember this formula?
Yes.
Okay. So if I say PO equals DO over KE, do you agree?
Yes.
Yes. I the new thing.
Eh?
Yeah, I agree.
I the new thing.
It's a new thing. How?
I'm not seeing
So
it.
one is PO is equal to one is
So this is how we calculate market value. So all is that we are just going to be shifting from the cost of capital towards business valuation, and it's going to be just the same ideas. Just the same idea. It is a one thing cost of capital here. Aha, why do you move it big kakra?
Yeah, so one two and so I see.
One thing as here.
Cost of capital, then one two.
And they how more.
And you must
Please, I'm absent.
Is it?
I'm absent.
You are absent. Okay, so let's look at business valuation, methods of valuation.
Listen, you're recording.
Everything you are saying is being recorded.
Nah, please don't point the idea. Let me mention
You
it.
are coming to solve
They told me.
Yeah.
I already have come.
That's what we have come. The video will be available on YouTube tomorrow morning. So if somebody is watching, they will see it like that. It's a classroom setting, that's why it's like that. Methods of valuation. Right, so methods of valuation. There are two things we are going to be looking at under the methods of valuation. We're going to first value equity, shares of the company, and then also what? Debt. Because you know the capital structure of the company is made up of what? Equity and then debt. So the first thing we want to look at is how do we value equity? So first, valuation of equity. There are various methods that can be used to value the equity of the company. The first one there is the asset valuation module. Asset valuation module. With the asset valuation model, it is where we are valuing the business based on what? Its asset base. Or taking into consideration what? Its asset base. The question we ask ourselves is, what are the conditions under which a business can be valued using the asset valuation model? What are some of the ideas? Can you discuss anything? Like, can you say anything? What are some of the conditions under which, if we are valuing a business, we will say, let's use the asset of the company to place a value on the company? Any ideas? So conditions or circumstances. The first thing we can talk about is when the target company is demanding an amount below which they are not ready to sell the company. When the target company demands an amount below which they are not ready to sell the company. So you are going to buy a company and the owners of the business say that anything, at most, we will take $200 million for this company. Then you have to sit back and look at what is giving them the guts to charge that amount. If that is the case, let's value their assets. Maybe it is because of the assets that they have. So that is the first condition under which the asset valuation can be used. Another thing that can, when the target company demands a minimum amount below which they are not ready to sell, the company demands a minimum amount below which they are not ready to sell the company. So you will have to find out what is the asset base of the company. 2, when the predator company wants to use the assets of the business, when the predator company wants to use the assets of the business. Now, what does this mean? A company can buy another company, and they are not buying them because they like the company. They are buying them because maybe B has a research and development center. So they are just buying them for the sake of their research and development. So they want to use their assets. So since we need your assets, we will value you using what? The asset base. Another circumstance is when it is a total takeover, where the predator company is buying the target company to continue with the business. Where the predator firm is buying the target company to continue with the business. So we are not buying you because we want to use your assets, but we are buying you because we want to take ownership and continue with the business. Then we can use the asset valuation model. In a simple language, we say that the value of equity under the asset valuation model equals your total assets minus total liability. That is the value of the company. So the value of the company equals total assets minus total liabilities. Please note that the total assets we are talking about here excludes goodwill. Why? Because goodwill has no fair value. So it excludes goodwill. So this is the value of the company, or value of equity. So value of equity per share will be equal to the net asset. You know, total asset minus total liability is what? The net asset. So the net asset divided by, or let me use this word, value of NET or equity divided by number of shares. You don't know how the examiner will ask you the question. He can say value the entire business, and they're the first one. He can say calculate the value per share, and they're the second one. That is why you have to know the two formulas. And please note that none of these formulas will be given to you in the exam hall. And since they are simple and they are connected to financial reporting, and all of you indirectly know financial reporting, so you will do it there. Alright. So this is how we value the business using the asset valuation model. Now, in your opinion, what are the advantages of using this method of valuing? Yeah. What are the advantages? If we use, in your opinion, if you are valuing a company and you are using the asset model, what are the advantages of this? Come on, you have to be flowy with me. If we are using the asset value to value the company, what is it? One of the advantages is that Information is readily what? Available. Because we just look at the balance sheet of the company and boom, we are able to value the company. So information is readily available. Another thing that we can talk about here is that to some extent it gives an accurate value of the company as at the date that the valuation is being taken place or is taking place. So it gives an accurate value of the company because we are using the net assets. But at the end, every sweet thing has a bitter side. So what are the disadvantages here? It may lead to overvaluation of the company. How that? How do you think that will? If they have massaged the figures, okay, that is a good way. Massage. So if they have engaged in something like window dressing, they because they know they will sell the company, they don't charge depreciation and those things. So still the assets are carried at a what? A huge value. So that will lead to overvaluation of the company. What else? What else? Now, goodwill, okay, which is a component part of an entity, is being what? Excluded in the valuation of the company. So it means that it is not other factors that contribute to the success of the company to this point are taken out if we use the asset module to value the business. So these are some of the things we can talk about under the first thing, asset valuation model. Sweet, straight to the point. Any questions?
Some of the assets are on lease.
So before we value, we have to check their notes and find out whether they actually own the assets. Like Ghana here, a lot of financial institutions, they have leased assets, but it's on the face of their balance sheet because it's a capital lease. So if you are valuing such a company, you would think the asset is theirs, but what? It's not there. So we will check the right and obligation, the ownership of the asset, the title deed of the asset, before we will value what? The company.
So would they give the opportunity to check how efficient or how well the asset, like maybe for example, the asset, you see the asset as new asset, but when you start using it, you start encountering like
Yes, certainly they would disclose information about the assets, but maybe the issue about efficiency of the asset you may not be able to determine. But they will disclose. Once they own the asset, you may also go out there to go and do evaluation or survey and find out, okay, this laptop, how much is it being sold now? Okay, maybe now it is sold for 800 cedis. But if I sell you this laptop right now, it has no battery. Are you getting? Or there is battery inside, but it doesn't work. So that is about efficiency. If I give you battery, I can give you battery right now. You use it for 30 minutes, it will go off. That's about efficiency. So to some extent, it has problems. We might have to.
But would they tell you that it has problems? Did they tell you?
Oh, we trust that they will disclose it in the notes. Yes, we try. That is where the massaging thing comes in. Window dressing comes in. Are you getting it? Creative accounting comes in. Because once they know that we are likely to be taking over, they will cook a lot of things in the financial statements. So that is why we as valuers, when we come on board, we don't just look at what is given, but we have to look at other factors in relation to that. So that is the first thing, asset valuation module. Second, dividend valuation module. There are times when we really don't want continuous ownership. We just want to earn some dividend. So usually, if we don't want to own the company totally, then we go to what? The dividend valuation model. Here, we want to control the entity, so we're going to use the asset base. But here, we want to find out what is the dividend payment ratio of the company. How long have they been paying dividend, and what dividend do they pay? Then based on that, we will value what? The company. Now, as we did in cost of capital, you know that a company may have a constant dividend payment ratio or a constant growth in what? Dividend. The same thing is going to happen here. So first, we're going to have where the company is paying constant dividend. So if dividend is the same, then we say that PO equals DO over KE. And you know the meaning of them already, so I don't have to talk about them. PO means market value. DO is the dividend just paid, or dividend. KE is the cost of equity. Please note that KE can be both what you know under the dividend valuation module or the capital asset what? Pricing module. Because when you are valuing equity, the examiner can give you CAMP records. So you use the CAMP to calculate the KE, then you use that to calculate the PO. So it's very important to know that. Second, when there is a constant growth in dividend, where there is constant growth in dividend, we say that the market value equals dividend 1 plus G over KE minus G. So this is how this is the formula we use in valuing a business when there is a constant growth in dividend. Please note that the G here is growth, and you know how we calculate growth already, isn't it? Using the Gordon approximation, using past dividend, or using percentage of retained profit. The same idea comes here. So about dividend valuation module also, these are the two things that we can talk about. But there are some limitations in using the dividend valuation module. What do you think are the limitations? If we use how much dividend the company pays and the current cost of capital of the company to value the company, what are some of the limitations you think we are going to encounter? And we discussed some of these things when we were doing KE and the cost of capital. Yeah, in case you have forgotten. Just in case you have forgotten. Yes, what are some of the things? Using dividend to value a company, meaning that it is based on past dividend, not on what? Future dividend. So using past dividend to pay or to value a company may not be a good approach. That is one of the limitations of it. Then even when we bring in growth in dividend, this growth thing is just an approximation. It is not something that is true. Because if we have year 1, year 2, year 3, year 4, dividend, year 1 we paid 5, year 2 we paid 6, year 3 we paid 4, year 4 we paid 7. Then we calculate growth rate of this and we get maybe 4%. What is the validity of this thing that next year dividend will grow by 4%? Because look at the changes. 5, 6, 4, 7. It increased 4, increased 4. So in this case, this growth thing here is also just an approximation. That is the issue about the dividend valuation module. Number 3 is using what we call market related modules. Now, the asset is based on the book value of the company. The dividend valuation model is based on how much dividend the company has been paying in the past. But there are certain sets of methods which are called market-related module. In other words, this is where we are going to place a value of the company, taking into consideration some other issues like the earnings. So the first one there is called the PE ratio. Using the PE ratio to value a business. That is the price earnings ratio. Using the price earnings ratio, we say value of equity equals earnings per share times the price earnings ratio. Earnings per share times the price earnings ratio. You have to be careful about the price earnings ratio, and so listen carefully here. When we are using the PE ratio, usually this module is used to value unlisted companies. Very important. In other words, companies that are not already listed on any stock exchange market. So we use this method to value them. But what is PE ratio? What is the formula for PE ratio, FR people? The share price. You said what? Something. The price earnings ratio divided by, the share price divided by what? Earnings per share. This is what we mean by the price earnings ratio. Now, the company you are valuing is unlisted. It's not listed on the stock exchange. So how do you get their share price? Their share price is what you are now calculating. So when we are using the price earnings ratio, the PE ratio we use is PE ratio of similar company that is listed or industrial average. Please, this is very important. So the PE ratio we use in the valuing of an unlisted company is the PE ratio of a similar company that is listed or industrial average. However, the earnings per share is certainly going to be the earnings per share of the target company. Are you getting the idea? So the company that we are valuing, we will use their earnings per share, because earnings per share there, what is earnings per share? What's EPS? Earnings per share. Profit attributable to what? Equity shareholders, or profit after tax divided by what? Number of shares. So EPS there, so we use the EPS of the target company. But the PE ratio, we use a similar company or an industrial average. But this is the big question. How can you use a company that is listed, their PE ratio, to value an unlisted company? How? It's not possible. When you do it, it will be wrong. So always, the value of the company at the end of the day must be adjusted. So please note that anytime you use the PE ratio to value a company, and you are using a similar company's PE ratio or industrial average, the value of the business must be adjusted. What does that mean? It means you can decide to take 70% of the value of the entity that you have calculated, or 70% of the PE ratio. What does that mean? So let's say that we have a scenario like this. So let's say we have a scenario like this. Men's Fish Limited wants to acquire Nams Gold Limited, and the information about the target is below. Profit after tax, 200 million. Number of shares, 100 million. a similar company in the industry of NAMS Gold Limited has the following information. Profit after tax 420 million. Number of shares 150 million. Market value per share $2.5. Required. What is the value of NAMS Gold? What is the value of NAMS Gold? I want you to hear the language carefully. The examiner did not say calculate the value per share of NAMS Gold. It says what is the value of NAMS Gold. It means the value of the whole business. This formula you have here is earnings per share, meaning the value per share. So this is value of equity per share. So I want you to clarify that. If we are calculating the value of the whole company, the value of the entity will be equal to the profit after tax times the PE ratio. So value of the whole company will be the profit after tax times what? The PE ratio. Now, so based on that and based on our illustration, what did I say? PE ratio is the PE ratio of what? Similar company that is listed or industrial average. The earnings should be the earnings of what? The target company. Who is the target here and who is the predator? And who is the NAMS Gold is the target. Who is the predator? NAMS Fish is the predator. So in calculating the value, so value of NAMS Gold Limited will be equal to their profits after tax times what? The PE ratio. And I said the PE ratio will come from the PE ratio of what? A similar company. So how do you calculate the PE ratio of the similar company that has been given us? I told you that PE ratio is what? The share price divided by earnings per share. So we've been given the market value per share is the same as the share price, 2.5. But we can calculate the earnings per share. So EPS equals profit after tax over number of shares. So what is the profit after tax there? 420 million divided by the number of shares, 120 million. So what do we have for EPS? $3.5. So the earnings per share is 3.5. We need to calculate their PE ratio. So their PE ratio will be equal to the market value 2.5 over the earnings per share 3.5. What do we have? Yes. Is that? 2.8. So what do I have for the PE ratio? 0.89. So this is the PE ratio of the company. So we will use this PE ratio to now value what? NAMS Gold. So NAMS Gold, value of non-gold will be equal to their profit after tax. How much? 200 million times what? The PE ratio, 0.89. What do we have? 17.57 million dollars. So this is the value of NAMS Gold Limited. But when Amika said, listen carefully, this value cannot be taken. Why? Because you use the price earnings ratio of a similar company. Now look at a similar company. Their profit after tax is what? 420. But look at the company we are valuing. Their profit after tax is only what? 200 million. Meaning this company is bigger than what? Them. So this value has to be adjusted. And then Amika said, when you get there, you can adjust it by taking what? 70% of the value that you have calculated. So that we will now say that value of the entity will be 70% of 178.57 million. What do I have? What do I have? 125. 125. Okay, so that's it. So this becomes the value fairly that we can place on what? Non-fish. This is judgmental. Somebody could use 80%. Somebody could use 75%. But whatever you use, you just clarify it, the reason for using it. So this is how we use the price earnings ratio to value a company. Earnings yield. This is why we are calculating the value of the company, looking at the future earnings that we can make on the shares of the company. So using the earnings yield, we say that the value per share equals earnings per share divided by the earnings yield. Earnings per share divided by the earnings yield. Please note, however, that earnings yield equals earnings per share divided by the market value times 100, or earnings yield can be calculated as 1 over the price earnings ratio. These are all formula things. So the examiner could give you the price earnings, then he will ask you to value the business using what? The price earnings ratio. So using this same formula or using this same question, let's place a value on the business. Quickly. Let's place a value on the business. So value per share will be equal to their earnings per share. What was their earnings per share we calculated? 2. Divided by earnings yield. How do we get the earnings yield? 1 over the earnings per share. What was the earnings per share in the question we solved? 0.89. So 1 divided by 0.89, what do I get? 1.12. So 2 divided by 1.12, what do I have? 1.78. You see? Are you seeing? So that is the idea. That's the idea. So that is how we value a company using the earnings yield approach. Just simple. It's not magic. You see how sweet it is? This is one of the sweetest topics, you know. So when it comes to equity, these are the formulas we have. Asset valuation, dividend valuation, price earnings, and then earnings yield. These are the four methods. How about our brother? Debt. Valuation of debt. Now when it comes to debt, I mentioned that you need to ask yourself, is it a redeemable debt or irredeemable debt? So is it redeemable or is an irredeemable debt? If the debt is irredeemable, then the market value of the debt is equal to the interest over KD. The market value equals the interest over KD. When we are putting tax inside, then it will be 1 over the interest over KD, 1 minus what? Tax. So if you check, you will see that we are just flipping the KD formula if it is irredeemable debt. But what if it is redeemable? If it is redeemable, who remember how we calculate the cost of debt for redeemable debt? We are valuing the redeemable debt. The market value of redeemable debt is equal to the present value of interest plus the redemption value. Please take care of that. When we are valuing debt, redeemable debt, it is the present value of interest plus what? The redeemable value or redemption value. Note that the redemption can be done at nominal or at premium, or the redemption value can be conversion into shares. Conversion into shares, and we will look at that in a moment. Always note that the redemption value, you read it on where? The present value table, isn't it? And then the interest, you read it on the annuity table. The same concept here, the same principle here. So that is how we value debt, and that is what you have to understand about business valuation. Yevi, any question? No, usually it's just premium. But if they say discount, you can treat it. But we've explained the discount. We say discount of 10%, meaning it will be 10% of 100, then 100 minus the 10, meaning you will bring what? 90. So if they say it, you can do it. But usually it's a nominal and premium. Or they will have a right to convert it into shares. So when you have a question where they can convert it to shares or take the money, you have to calculate the two values. The one that is higher becomes the redemption value. If you were the one who bought a redeemable loan, and on conversion, you will get a share with a value of $200. Or on redemption, you will redeem it at $150. What will you do? You will convert. So at conversion, you will make that analysis here. So if the debt can be converted into shares, you calculate the conversion value, then you calculate the redemption value. So you look at the two, the one that is highest becomes the redemption value that you are going to use here. Okay, so let's get busy now with some real questions.